In 2024, Bitcoin made it to Wall Street, for real. With the approval of multiple spot Bitcoin ETFs in the US, institutions can now buy BTC like they buy shares of Apple or gold. For some, this was the ultimate validation. Mass adoption is here, they said. Wall Street finally believes. But not everyone's celebrating. Because behind the headlines and inflows lies a deeper question. Are Bitcoin ETFs a Trojan horse or a ticking time bomb? Welcome to Plugged in Crypto, your connection to crypto. Let's break it down. First, the upside. Spot ETFs give traditional investors a familiar way to gain exposure to Bitcoin without having to touch private keys, wallets, or exchanges. This opens the floodgates to pension funds, asset managers, retirement accounts, and institutional allocators who were previously locked out. And the numbers don't lie. Billions of dollars have already poured in. It's a milestone, a credibility boost, a sign that Bitcoin isn't going away. But there's a hidden cost, because when you buy Bitcoin through a BlackRock ETF, you don't actually own the Bitcoin. BlackRock does. Fidelity does. These giant custodians hold the keys. And that's a far cry from the original Bitcoin ethos. Bitcoin was born as a tool of decentralization. Not your keys, not your coins wasn't just a meme, it was the point. But now we're watching an inversion. Instead of individuals holding Bitcoin to escape financial institutions, the financial institutions are now holding Bitcoin and offering it back to individuals as a tradable share. It's Bitcoin, but wrapped in the same custodial layers we tried to leave behind. And that raises serious concerns. First, custodial concentration. If a handful of asset managers hold billions in BTC, they gain outsized influence over governance, markets, and liquidity. Second, regulatory capture. If governments decide to regulate or freeze ETF assets, users can't opt out. You can't withdraw to a wallet. You're stuck in the system. Third, the illusion of decentralization. While the Bitcoin network remains decentralized at the protocol level, the actual ownership starts to centralize. In the hands of a few giant players. It's not theoretical, it's happening now. BlackRock, Fidelity, ARK, and other ETF issuers now own and control massive amounts of BTC. If this trend continues, Bitcoin could become less of a self-sovereign tool and more of a regulated, securitized product. And when that happens, what's left of the revolution? Still, the story isn't one-sided. ETFs also reduce barriers. They educate, they normalize. And for people who can't or won't self-custody, ETFs provide an on-ramp. Maybe, just maybe, the ETFs are the Trojan horse we're sneaking into Wall Street, not the other way around. Maybe over time, these financial giants will be forced to adopt Bitcoin's rules, not impose their own. Maybe institutions will hold BTC on behalf of millions. But some of those millions will eventually take the next step and withdraw to self-custody. Maybe ETFs are a gateway drug, or maybe they're a trap. The truth is, we don't know yet. But what's clear is this. The arrival of Bitcoin ETFs is not the end of the story. It's the beginning of a new phase in Bitcoin's identity crisis. Will it stay a decentralized sovereign money, or slowly morph into a Wall Street product controlled by the very institutions it was built to bypass? The answer depends on what people do with the access they now have. Will they just buy the ticker, or will they buy the idea behind it? Please like and subscribe, and click the notification bell to stay plugged in.